MasterCard, ticker MA, is currently trading at $449.25, and over the past year, the company is up by almost 20%, and over the past month, the company is down by almost 2%. And so I want to figure out whether the company is currently under or overvalued, and if it is time to add it to your portfolio. So we'll jump to my stock valuation spreadsheet, and I will plug in the ticker MA and wait for all the data to show up. Now, right away with MasterCard, we can see that they currently have a dividend yield of 0.59%, which gives us a dividend payout of just about $2.64 and a trailing free cash flow payout ratio of only 20.07%, which is a very nice free cash flow payout ratio, meaning that MasterCard has a lot of free cash flow to invest back into the business and buy back shares or pay, for example, for their total liabilities, which have increased by almost 10% since last year. And of course, if you'd like to download these spreadsheets for your own personal use, you can do so at my Patreon in the link in the description. Now let's jump to our 9-pillar analysis and evaluate MasterCard based on its fundamentals. So right away we can see that 2 out of the 9 pillars are sitting in the red, and that is the price to free cash flow over the past 5 years and the 5-year PE ratio. And what both of these metrics actually mean is that you would be overpaying for MasterCard based on their earnings and based on their free cash flow over the past 5 years. But if we have a look further, it does look like that MasterCard has been increasing their revenue as well as their free cash flow as well as their net income over the past 5 years, about 10% year over year, which looks very nice. Now, they have also been buying back shares, which I love with every company, as it means that over time I will own a larger percentage of the company. Specifically for MasterCard, they have been buying back shares at about 2.15% year over year, which is a very decent buyback rate. Now, their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.55, which means that they can pay off all their long-term liabilities using their free cash flow within about 3 years, which is phenomenal. And finally, their consecutive dividend growth is sitting at 17.11% year over year, which is phenomenal as well. But let's scroll a bit down to the financials and have a look at the graphs. We can see that the PE ratio is actually decreasing, so what we saw up here was the average over the past 5 years, but in 2023 the PE ratio was only sitting at 35, which means that you wouldn't be overpaying that much for MasterCard after all. Now the revenue is rising, the net income is rising, we can see the trend in the red. And if we scroll further down, we can see that the shares outstanding are decreasing as well. This is 1 billion and this is 996 million. That's why the graph isn't working properly. But if we have a look at the past 4 years, we can see that the shares outstanding have been decreasing indeed. Now the free cash flow is increasing as well. The long-term liabilities are increasing by quite a bit, but as we saw up with the long-term liabilities over the 5-year free cash flow, there really isn't an issue with that. Now looking at the dividend, since 2019, the dividend has risen by quite a lot, by almost 40%. And if we scroll all the way down, the earnings per share and the free cash flow per share are both increasing, so that is phenomenal. But now let's try to calculate MasterCard's intrinsic value and really figure out whether the company is under or overvalued. So let's jump to our first valuation model, the Grams formula. And here we will use the Grams formula revised, and we will take the earnings per share of MasterCard, the base PE sitting at 7, 5-year earnings growth estimate, the growth rate multiplier sitting at 1.5, average yield on AA Corporation bonds sitting at 4.40, and the yield on AA Corporation bonds, the current yield on AA Corporation bonds, and we will get an intrinsic value of $460.17, which is 2% higher than the current trading price of the company. Now, the Grams valuation is based on the earnings of the company, but let's evaluate MasterCard based on its free cash flow as well. And to do that, we'll jump over to my discounted cash flow model. And here we will take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at about 11.19% year over year. Now, looking at the analyst growth rate projections over the next 5 years, I will project a growth rate into the future year over year of 10% to be conservative. I will then use this growth rate to predict the future free cash flow over the next 8 years, including the terminal value, and I will then plug in a discount rate at 7%. So I will use the discount rate to calculate the present value of that future free cash flow we calculated before, And I will sum up all that future free cash flow, add any cash and cash equivalents, subtract total debt, and get an equity value, which I will divide by the shares outstanding and get an intrinsic value for MasterCard to be sitting at $402.32, which is actually lower than the current trading price. The next model I want to use to calculate MasterCard's intrinsic value is the multiples valuation model. And normally here we would take a company and compare it to its competitors, but as MasterCard doesn't have much competitors at all except for Visa, we will only compare MasterCard to Visa. So I will take Visa's stock price, its earnings per share, and calculate its PE ratio, which I will then multiply by the earnings per share of MasterCard and get an intrinsic value to be sitting at $425.40, which is slightly lower than the current trading price, showing that at the current time Visa might have better earnings per share than MasterCard. But let's now move to our final valuation model, which is the dividend discount model. And here we will take MasterCard's dividend payouts over the past 5 years and calculate the average growth rate to be sitting at 17.11% year over year. Now I will project a growth rate of 10% year over year to be conservative and plug in a yearly dividend frequency of 4 as MasterCard does pay out dividends quarterly. Now, when the projected growth rate is higher than the WACC of the company, the intrinsic value comes out negative when using the normal dividend discount model. So I do have my alternative dividend discount model, which uses the next year's dividend predicted by our projected growth rate, the stock price next year predicted by analysts, and the WACC of the company to give us an intrinsic value of $460.49. So now let's move to our ultimate valuation. And here we will average out the 4 valuations we did prior and get an intrinsic value of $437.10, which is 2.71% lower than the current trading price of MasterCard. Now, from my experience, it isn't always a good idea to compare a company to only one company in the multiples valuation. So for this case, we will actually delete V for Visa and get back to the ultimate valuation. And we'll see that the intrinsic value went up slightly after we only average out the 3 valuations. And so using this method, if we plug in a margin of safety of 15%, we would get an acceptable buy price at $374.85, which when we have a look back at the stock screener is actually slightly higher than the 52-week low of the company. So there was a time where you could buy the company below its intrinsic value. And with that, I hope you did enjoy the video. Make sure to leave a like and subscribe as it really helps me out a lot. And with that, if you'd like me to compare MasterCard to Visa in my future video, make sure to let me know down in the comments.